But like we said, absolutely no complaints. All right, let's get a move on, talk a little bit more about the big triggers in the market as well as what the outlook is when it comes to the direction and the trajectory. Sanjay Parekh is the founder and CIO of Soham Asset Managers and now joins in on the show. Thanks so much for taking time out. Let's get in a sense first up from you as to how you're looking at or really painting the picture for the equity markets at a time like this. I mean, we're talking about levels of about 23,700 already, and it's just half of the year. The broader markets as well have been definitely participating. Do you believe that the undertone of the market is continuing to look positive for the rest of the year?
Yeah, good morning to all of you and the viewers. So basically, structurally, we are very, very positive because at least from 94, I've never seen all the balance sheets firing. And when I mean this, right from government balance sheet in terms of fisc, we are in control and getting better. The roadmap for consolidation of fiscal deficit will continue. The banking balance sheets are very strong. The corporate balance sheets, because, clearly those are also at all-time low on leverage. RBI also has enough room in case they need to support in terms of liquidity. The reserves, the forex reserves are at the best ever. Household balance sheet, which is most important, we have a huge wealth effect of $1.5 trillion. So all these structural advantages is what is leading to the equity markets, But I mean, having said that, we all have discomfort on valuations. We think it's going faster. In terms of valuations, now we are on Nifty at 21 times on 25. But as we move to 26, even if you take 1250 rupees of earnings, and then 20 times, that's 25,000, which is an upside of less than 10%, which is not great for equities. So what we think is that there is a possibility of time correction and price correction. But if you take a 3 to 5 year view, and if the expectation of return from large cap is reasonable for market Nifty, which is 12 to 13%, that is very much doable. In the mid cap, small cap, we think there is froth in certain segments, and one has to be careful in those segments where there is froth, but there's a lot of opportunity bottom up there as well.
What are your thoughts on, you shared your portfolio valuation that, are just around 15 times next year and was even lower than the Nifty as well. But what is the range your portfolio is trading at? What's the most expensive stock and what's the least expensive one?
Yeah, so Jai, we are hardcore GARP investors. And, a little dated on 31st May, our price earning of a portfolio was 15.3 times for 20% growth rate, while Nifty is at 18 times on FY26. But more so, our ROE is 16% and our growth is 20%. So for us, it's not about high price earning. It's just that in sync with growth, we would want to pay price earning or any other mode of valuation. So we would have stocks at 25, 30 times as well, but then the growth rates would justify that. But the overall portfolio, we are very comfortable at the valuation, and this style of growth at reasonable price with a little bit of value bias has helped us over last 2 years for the alpha that we've created at 31% plus compared to Nifty TRI with 80% large cap.
Right. Okay. That's quite interesting. Sanjay, banks clearly, they seem to be the space even within the Nifty, which at an index level, you may find comfort or rather uncomfortable valuation, but clearly not with banks. Do you think not just banks, but the entire financial space or BFSI, as I would like to categorize it, do you think that's the go-to story? And even when you talk about the India growth story, the channel through which you're going to play that is going to be via banks.
Yeah, absolutely. So 38 to 40% of the index Nifty is financials. And with all, world over, whenever you've seen all these balance sheets being in place, the positive ripple effect is on banks. The largest PSU bank is at a net NPA of 0.3%. And having said that, seen that space now for 20 years, there was a 10-year period when they had to clean it up, But now the net NPAs are very, very low. And the good part is, even if they bottom, the credit cost will only gradually go up. So that is where, now the book value sanctity is established. the growth rate, even if it's 15 to 18% and ROE from 16 to 18%. Yet, even if you don't take re-rating upwards, the earnings itself will give you the appreciation in financials. So that is where on the banking piece, we are positive. On the larger cap space, both in the private sector and public sector, where we are the largest PSU with us. All other non-financials also, very clearly the opportunity is very large. Be it broking, wealth managers, fund, AMCs, and then of course the financial infrastructure space. Of course, a lot of space, the valuation is not reasonable. Some of it is getting frothy, and hence you need to just balance where you get that growth at reasonable price. But we are very positive on the financial space overall.
Sanjay, what are your thoughts on the entire cement space? I see two biggest names in your portfolio, Ambuja and Grasim. But one is turning an acquirer in order to reach their massive goals they've set for themselves 5-7 years ahead on the capacity addition front. Obviously, that cannot come completely organic. So inorganic route has to be taken. The other one has beyond cement a positive on Vodafone resurrecting, going towards jewellery and other stuff. So is it the cement you're kind of playing there, or what exactly is the plan?
Yeah,
Just the business model.
Yeah, so one is cement in the near term may be weak for this quarter because first 2 months were weak. June has been better, but overall structurally with this emphasis on infrastructure, the large players very clearly will be beneficiaries. They will be acquirers. So we participated through Ambuja, as the very aggressive on acquisitions, and they're doing it very smartly. They're not overpaying for it. And then the cost lever with all the synergies of the group, they are going to significantly better it. So that is one area where we are very positive over the next 3 to 5 years. And we've seen that in the recent acquisitions and even the efficiencies that they have built on the cost side. While it is not cheap now, valuations are rich now, but I think you need to hold on to such quality stocks where the growth is going to be very aggressive and the management is really on a top of it on all multiple fronts. But the other player, Grasim, we own where, of course, we benefit through Ultratech, which is a very large ownership for them. And then, of course, the paint business, we believe they have a right to win. It may take a little longer, but they still would really appreciate more of as they execute. And then, of course, the VSF and chemical piece are on a low in terms of EBITDA. But I think on a cyclical levels, they could only get better from here slowly. So if you take the whole SOTP, even taking a discount, and if you take a 3 to 5 year view, even from year on, we're very positive on that name. So that is our view on cement.
Where it is that you stand when it comes to the entire consumption space in light of the fact that we are expecting sort of a policy fillip on the rural side and that recovery really to play out. How are you looking at the story when it comes to the basket of consumption?
Yeah, so on consumption, we've underweight. In fact, we don't own any FMCG stock right now. And we have taken sectoral deviations to get the alpha. So all over, the very simple view was overweight domestic, global underweight. By and large, it has helped. We recently increased our exposure to metals 1.5 months back, and that has again helped us. So we are open to changing even if we were to increase weight in FMCG. But yet we see that the growth is not even 10%, volume growth of 3 to 6%, and valuations still are at 40-45 times. So we still feel that, they need to correct a bit. The opportunity is very large. The rural recovery will happen. It could take 1 or 2 quarters, but certainly I'm sure government emphasis on spending in rural will be there. But just that valuation is discomforting us. And we are looking out for opportunity bottom up if we can get an idea there at a right valuation.
So Sanjay, since you did highlight that you guys are hardcore GARP investors, other than banks and the pockets that we've discussed, where is it that you still find value on the table where you would perhaps either recommend adding on to the positions or even get in afresh?
Yeah, so it's tough. You're right. Markets are not cheap. You have to look for those ideas, and take my word, every month in large caps, you get ideas. A few months back, 7-8 months back, HPCL were at a very, very low, HPBP both, at almost abysmally low when the markets were really going up. And then you saw 70-80% returns. 2 months back, one of the leading private sector bank had some issues which are interim issues on the digital space. And, it came at 1.65 times price to book. And that was, I think, on a 20-year low price to book. And that's where we never had it, but we just bought it at that level. So every month, either in the large cap space or in the mid and small cap space, Ajay, I just spoke about Raymond's. We added 3 months back, and not to trumpet, but there was a mispricing and there's a value, and there will be a demerger which will help them unlock the value. And we saw it flaring on 40-50%. So there will be pockets of opportunities. That's what we see. And otherwise, we play low, play a loose ball. That's our mantra right now. And be active only when there is value, selectively across large or mid caps. So but there is less value left even in the large cap space at the current levels.
All right, Sanjay, we'll let you go on that one. Thanks so much for your time this morning.
If you like this video, then like, share and subscribe to ET Now.